We are a charity-owned ethical lender. We specialize in providing microloans, low-cost microloans to people on low incomes, people with thin credit files, people with poor credit scores, people who have been excluded or are excluded from mainstream credit. Over the past 10 years, we have refined our algorithms, coupled with technology such as open banking, in order to be able to make good decisions to provide affordable and responsible lending for people who, quite frankly, have no other options to them other than the high cost predatory lenders or illegal lending. We do not lend cash. We never have done. It is not one of our strategic aims. We lend on a prepaid MasterCard, and that MasterCard can be used at one of our retail partners for the purchase of essential items for the home and family. This helps our customers help themselves. They are therefore not tempted to misspend the loan as it would be if it was a cash loan, for example. And it also gives some protection to those customers who may be suffering from domestic or economic abuse. Given a restricted card that can only be used with certain retailers is perhaps less attractive to an abuser than actual cash. Our customers are primarily female, aged mid-late 20s to 40, parents of school-aged children living in social housing or private rented accommodation, and with an annual income in the lowest decile of income in the UK. APR is a regulatory tool. The viewers will know that, your investors will know that. It is there to standardize costs across a whole range of different products in financial services so that people can make comparators between them. Our customers care about how much they pay back in total. They do not care about the APR number. And the reason is because APR is an annualized measure to show the cost of borrowing over a year. It works great with mortgages, with significant loans that are sizable sums over a 12-month period. But if the loan is for a few weeks or a few months, multiplying that interest rate into a yearly rate makes the cost look disproportionately high. So what do I mean? Well, if you take a £100 loan and you have that loan for a month, and at the end of that loan, the fee, if you like, the cost is £10. So as a borrower, you pay back £110 after the month. You automatically think, well, that's a sort of 10% type of interest rate. But the APR is far different because it has to be multiplied over the year. The APR is over 210% for a £100 loan for which you pay £10 cost over a month's period. So it is 64.8%, which is our APR, absolutely. But our customers will look at our sliders on our website to see how much they want, the term that they want it for, and they move the sliders around. We know this because we capture the data points to see how much they're going to have to pay back as a final sum. So for a real world example, if you borrow £200 from Fair for You and you borrow that for 5 months, you will pay back £36 of interest plus the £200 loan, so £236. So the final thing I'll say, I'm sure you've got further questions on this, Jerome, but the final thing I'll say is this, that if anyone watching really has 1.5 minutes, 1 minute 34 seconds to spare, they should Google Michael Sheen APR, and you'll see the actor give a real world example and a perfect example of why APR does not work for short term lending. It's a really informative 1 minute 34 seconds. Michael Sheen APR video. If you put it into Google, it's a YouTube video and it's well worth a watch.
I think it's fair to say that the situation for the customers that we're looking to serve is extremely challenging right now and has been extremely challenging for the last few years. You know, inflation is remaining high, static, but high. You'll have seen in the news today that food prices are continuing to surge. You know, even your budget supermarkets are saying that the cost of food is likely to have to go up. And it's those essential household bills of energy, water, food bills that are really impacting the household budgets of the people that we're looking to support. You know, there's statistics around the increase in the annual food bill is, you know, £1,000 higher than it was before the pandemic. Energy bills don't look like they're going down anytime soon. And it's putting that question of eating or heating firmly on the radar for a lot of people. There's also challenges, particularly when you get into energy, which people may be aware of around prepayment meters and forcibly putting people on prepayment meters and the pressures that that puts on people when they're really struggling on a day-to-day basis. And I think what it means for our customers is that they look at their finances and they manage their money day to day. You know, they don't have the ability to look forward, to plan, to have foresight, perhaps in the same way that some of others are lucky enough to do, because their income is inconsistent. And when those bills come in, they're just unable to manage how that's impacting on the overall amount that they've got left. So you know, I think it's fair to say that some of the poorest people in our demographic are getting poorer and are finding it increasingly hard to stay with their, you know, their heads above water. And what we've seen as well is that the people that we're looking to serve, that group of people is getting bigger. And it's getting bigger with people that perhaps we wouldn't have been looking to serve 5, 6 years ago. So the working person is falling into a demographic that's now really struggling, where, you know, the amount that they're able to earn through working is not able to support a household with children in it. You know, gone are the days where one working salary is able to support a household of 4 people. You know, we're just not there anymore. And I think particularly with some of the changes that the government has announced or reversed in terms of benefits changes, has caused people a lot of anxiety, a lot of stress. They're not knowing how to plan for the future because they don't know what their overall income changes might result in. And they're looking at what options are there. Where can they go to support them when something happens and they need £250 that they simply don't have in savings to be able to support them with an unforeseen bill? And when you look at what's available, it's not much. You know, there's some of the previous high cost short term providers, such as the Bright Houses of this world or Morse's Club and Provident, have gone. You know, credit cards and overdraft facilities might be there if they're available to our customers, but it's not likely that they are. And then you get buy now, pay later options, which are very popular, are continuing to grow. You know, I think it's estimated that nearly half of all adults have used buy now, pay later, but nearly 25% of those people have missed repayments on it. And when you miss repayments on it, it suddenly doesn't become a 0% free option to split your cost. There's impacts and late repayment fees. And inevitably, given the way that the regulation is going and them having to report on credit files, that will impact credit files as well. And a lot of people aren't aware of how that buy now, pay later kind of mechanism works. So it's all well and good when you can make the payments, but things change when you can't. And if those options aren't available to you, you know, where else do you go? With the range of credit options declining, it's creating an environment where illegal lending and loan sharks is, you know, is what's filling the gap in demand. And I think that's a really scary prospect when you look at how many people in the UK have used or believe that someone in their household has used illegal money lenders. It's 3.3 million people. That's a huge number of people who are, you know, exposing themselves to you know, predatory individuals who are, you know, are not regulated, have not got their best interests at heart, are not, you know, bound by consumer duty and some of the other things that all of our organisations are. And that's the realistic position for a lot of our customers, is they don't have the savings, they don't have the backup, they don't have the certainty of their income. And when they get those one-off shocks and bills, there aren't many options available for them to go. And that's why it's increasingly important that, you know, CDFIs, credit unions and others in this space are able to step into that gap to keep people in a safe and regulated environment where they've got options to, you know, to support them.
Because of the nature of our business, the fact that capital is recycled because we're a short-term lender, money comes in, money goes out. Over the lifetime of a 5-year bond, an investor could expect their money to be recycled probably 5 times during the course of that bond, that investment. And what the experts have told us is that for every £1 invested, that creates £58 of social value. And that's what investors can expect, which is, as you've already said, absolutely stunning, really, compared with other social impact and social value calculations for other organizations. The most recent reporting indicates that 36% of all adults in Scotland are living in financially vulnerable circumstances. Let me just say that again. 36% of all adults in Scotland are in financially vulnerable circumstances. And looking at Fair for All Finance survey, you mentioned them earlier, Jerome, and it's on their website, shows that a quarter of the Scottish population cannot pay for an essential item for the home of £500 without borrowing. So, and nearly 10% of those who were declined credit ended up going to a loan shark. So, aside from credit unions, Scotland is not well served for affordable short-term credit options. We firmly believe that Fair for You has a role in enhancing the availability of affordable and ethical credit in Scotland. So what we have done, and details in the pack, I won't repeat in any detail, but we've devised 4 specific initiatives which build on our existing value proposition, things that we've already mentioned in terms of the food club and the shopping cart in particular, but they are tailored to the demography and geography of Scotland.
I think one of the things that I would like to highlight here is that our customer journey is designed to minimize provisioning risk. So we built our journey deliberately customer focused with flexibility. So our customers can align their payments and their repayments with their income and their financial circumstances, and they can change that whenever they want, as many times as they want. So we know that our customers' lives are sometimes chaotic, that their income doesn't match their expenditure and it's inconsistent. So having a set repayment timeline and a set repayment rate often doesn't work for them. So they can move it around. They can change the frequency, they can change amounts, they can, you know, they can double pay one week if they've got more funds than they expected to make up for missed payments. And that's all done whenever they want, with no fees for doing so and as many times as they want. And they can do it all 24/7 throughout the account area that's on there through the website. And that's really important to enable them to minimise the risk of them reaching that stage where they need provisioning, and to provide them with as much support to be able to keep making payments, to keep them on a plan to protect them and their credit file. And once provisioned, we stop charging any interest if it's an interest-bearing loan, and we will not reinstate any interest on the loan, even if they continue to start repaying us back. So there will be no further interest charged on the loan at that stage. And the approach has been designed to support loan book stability, protect customers, and also think about the kind of the sustainability of the organisation. Now, we know that, as I said, customers have, you know, some challenges sometimes from a financial perspective. So, you know, it's important that we highlight we don't charge any late fees, we don't charge any missed payment fees or any admin fees at any stage of the loan life cycle with us. All of our loans are unsecured. They're managed entirely in-house. We don't sell our debt on to anybody else to work or interact with our customers. As I said, those repayments are flexible by design. Our interest is calculated daily on a reducing balance basis. So any missed or late payments will only result in a slightly higher interest accrued over the life of the loan because, the balance is slightly higher than perhaps they would have been if they'd made their payments on time. And we have a multi-channel communication strategy. So we work with our customers via phone, via email, via SMS. They can go, as I said, onto the account area and kind of make changes to their account there as well. And that approach emphasises early informal contact to re-engage customers and support repayment where we can. If a customer is particularly struggling financially, we'll look at suspending interest if it's an interest-bearing loan. We'll work with them on an income and expenditure form so we can get a proper position of what's going on for them financially, what might be the right thing to do. And so that works for some of our customers. We'll also take reduced payment plans. So if a customer had originally contracted to pay £10 and they can't make that £10 anymore, but they can make 8, we'll work with them to take the 8. As I said, there's no fees for doing that. All that will happen is that they'll pay a slightly higher amount of interest because the loan agreement is expecting £10 versus the 8. And, that's the main focus for us is how can we keep a customer being able to repay something that's manageable for them. So our focus is always on a manageable and sustainable payment plan that they're going to be able to continue to pay so that we can continue to report to the CRA that they're repaying it for the benefit of their credit file.
The story of Fair for You over the last 10 years has been about tackling financial exclusion, as you've heard today, making a real difference to people's lives. We are really excited about our plans to do more in Scotland. We can only do that with your support. If you invest in the Fair for You Scotland bond, your investment will provide a social return over the 5 years of £56 for every £1 invested. That is a phenomenal return on investment. And you, of course, will receive an 8% per annum, as Jerome has said. Our vision, our stated vision, is to change lives through better lending. With your investment, we will be able to change many, many thousands more. So thank you.